because we are live on Facebook right now. Welcome everybody to the Not Your Average Investor Show. I am your host, Pablo Gonzalez. My co-host as always, Gregg Cohen. Say hello, Greg.
What's up, everybody? I want to say especially hi to everybody on Facebook. Always good to have you guys there. I know our numbers are growing there. And, you know, when we started, it was hard to get one person to follow us on Facebook. And I was just going live here a few minutes ago, and we had 20 people that were there on a random Facebook Live. So appreciate all of you. And if you would, share it with your friends and your family. It just means so much to us. So thank you all, especially for being here.
Heck yeah, man. Good call. So today is Thursday, which everybody knows that, but you may or may not know if you haven't been here that Thursdays is a Q&A format. So I got some questions prepared for Greg, but we want you to participate in this call more than anything. So I have a little bit of housekeeping to give you for those that haven't been here before. If you will just stop for 1 second and look at the bottom of your screen and hit the chat button. And then when you see in the text box, it says all panelists, hit that little blue button and drop that and select all panelists attendees so that when you chat, you're chatting with not just us, but you're also chatting with your fellow group members here. And who knows, maybe make a best friend. And then if you want to leave a question for us to ask on air, go to the Q&A box, you pop that open, and that allows you to put in questions that I will then ask Greg on air, and the lucky few will also make it onto our LinkedIn and Facebook and whatever, because we repurpose all this content, because that's what we do here at the Not Your Average Investor Show. And the last little bit of housekeeping is, if you are new to the JWB universe and you want to understand rental property investing and how JWB does it, and how, you know, quite frankly, what the best markets are, what to look for, you know, how to really just start at a high level, go to jwbwebclass.com. That'll be a well-spent use of your time. And if you want to take the next step, you want to get on a live call with the JWB team and find out how rental property investing could work for you specifically, go to chatwithjwb.com, pick a time and date, hop on a call with our team. Easy peasy. Greg, are you ready for Thursday's Q&A call today?
I am born ready, brother. Let's do this. Let's recognize some of the great things that everybody has been doing. Lee said I talked to my wife about my 5 closest friends last night. That's coming straight from the book that we had Brian, who was the author of the book, What Matters Most, on the show on Tuesday. He talked about analyzing who your 5 closest friends are. Awesome to see Lee taking action there. Roldan said he's reading for the first time Secrets of the Millionaire Mind by T. Harv Eker, a classic there. Marilyn said she's reading What Matters Most. Really awesome to see. And Mike Foster said the best thing that's happened to him is 2 of our little grandchildren are coming over for the day in about 10 minutes. That is fantastic. Mike, I can't believe you're going to make your grandchildren wait to finish the show. I mean, I really feel like I'm so surprised that you would do that to your grandchildren, Mike.
Mike, if your grandchildren have questions about rental property investing, put them in the question box. We'll get an answer.
Watch with me. There we go. All right.
And Lee Bishop here put in the question box. Greg, I was able to give my first testimonial to a potential client for JWB, and I thought it went very well. Mike Stetson gave my name, and I was happy to do it. Thank you, Lee. You're the best, man. So Greg, we just talked about Lee implementing the 5F in his life based on our call that we had on Tuesday with Brian Scrone. Highly recommend getting the book. Can you tell me where you're at? You said you've been implementing them. Can you tell me a little bit about it?
I have. You know, this book, we only want to bring people into our community here that we really, really believe in. And Brian has been a personal friend of mine for a long time, and I really believe in the message in his book. And I read the book for the first time a few years ago. It was great for me to reread it again this year. I've reread it a few times. And one of the things that jumped out to me is that the book talks about the 5 F's: friends, family, finances, fitness, and faith. And in every person, you're going to have a different order of priorities. So when I was going through the book the first time, I actually looked at what I wrote down as my priorities. And then I looked again this year at what I wrote, and I said, you know what? Maybe that isn't exactly what that priority is. So it's been really healthy to reanalyze that. I'm actually spending some time in thought thinking about what those priorities are. And then the thought is to be intentional with your time and just make sure you're spending your time according to those priorities. So I'm going through that process right now. But one of the big takeaways that I had that's very easy to implement, and I was telling Pablo about this morning that I've been doing this, is the idea of holistically growing is very important to Brian in the book. And that no matter what your priorities are, you want to make sure you're taking a small step, at least in every one of those priorities on a daily basis. And so for me, that starts with, and what he recommends is every day being intentional about one positive action in each of those categories. So I've been doing that for the last, 4 or 5 days. And I want to tell you, I've seen some really impactful things happen for it. So like, for example, one of my best friends lives here in Jacksonville, but it's about 40 minutes away and it's hard to see him. And, I haven't seen the guy in probably 3 months. And we've texted about hanging out. Well, one of the F's that I put down for friends was I'm going to text Tim and I'm going to ask him if he wants to play basketball on this date. And I'm going to confirm a date for him. And that was my thing. And I reached out to him, and the response I got from one of my best boys was like, man, it's so awesome. This is great, man. I've been missing you too. Let's do this. And, and I was like, man, this stuff's really powerful. And I've continued to be intentional, and it doesn't have to be a big action, right? Like one of my actions for the faith one was just to simply download a prayer podcast. That was my action for the day. And I did that, and it was great, And so like these little actions, I think have been very impactful for me in the short time that I've been disciplined and actually doing it. And it makes me want to continue to do it. So I would recommend that for everybody listening as well. Read the book, but if you haven't read the book yet, choose one thing within the 5 F's: friends, family, finance, fitness, and faith, and one small action every day that you can do and be intentional about it. I think it'll make an impact in your life.
Sold. You had me sold this morning, so I'm gonna start doing that starting tomorrow. So, all right, Gregg. I'd like to start off with, and I want to encourage everybody to put questions in the chat. Roldan, great question. We're gonna get to that. I want to ask you. You had a Facebook Live earlier this week about cash on cash return, and everybody that watches this show knows that I'm a super real estate expert, but I have a friend that hadn't heard that term before. Can you explain that so that my friend understands?
You sure you want me to explain this one, Pablo? You sure you don't want to explain this one?
It's your show.
All right, I'll pick this one up, Pablo. This is something that's really important. So a client of ours, Steve, had asked this question on our group and said, is cash on cash return the best metric to look at when analyzing a rental property investment? And it's such a great question. So many people have this wrong. So cash on cash return measures how much positive cash flow you have. And the higher the number, the more positive cash flow you have compared to how much you put down in the investment. All right. So cash on cash return is measuring your gross rental income coming in, and then it's taking out your principal and your interest and your taxes and your insurance payments and your property management fees and your maintenance and your vacancy costs. And you're left with something that's called net operating income. Then you want that to be positive, by the way. That's positive cash flow is what we're talking about there. And then you divide that by the amount that you had to put down in order to generate that positive cash flow. That would be your down payment plus your closing costs. So the question is this the best metric? Well, this is a good metric to look at. It is the first place to look, because the first and most important step when buying rental properties is to make sure that they are what, Pablo?
Cash flow positive.
Nailed it. They got to be cash flow positive, right? That is the most important thing. We're investing in assets that pay for themselves every single month. It's one of the beauties of this asset class that you can't get in a lot of other asset classes, right? So it's got to be positive cash flow, and cash on cash return measures that positive cash flow. So it's a good metric, but it is not the only metric to look at. And here's where a lot of investors fail. They only pay attention to cash on cash return. Cash on cash return only measures your positive cash flow, but there's 4 other profit centers that are really, really important. So cash on cash return measures positive cash flow. You need to get positive cash flow. Once you've accomplished that, then you need to go a little bit farther, and you need to look at the other factors, the other positive profit centers that will contribute to your overall rate of return. All right, let me quiz you again, Pablo. What do you think those other profit centers are? I'm going to get you, man.
I know it's appreciation.
There you go.
I know that it is debt pay down.
Yep. Principal pay down, debt pay down, same thing.
Principal pay down. I don't know. I don't know the rest.
Good. That's good. Tax savings is the other one. So tax savings, the amount that you're able to write off as a depreciation write-off and how that limits your tax burden. And the last one is how you benefit from inflation long-term. When you get smart debt, the value of rents and prices and goods and services goes up over time and it devalues that debt. So those are other profit centers. The biggest one out of that is home price appreciation. Is home price appreciation included in cash on cash return? No. Right? Are these other profit centers included in cash on cash return typically? No. So you're looking at cash on cash return for the net cash flow. Once you get there, go to these other profit centers. The reason why I'm so passionate about people looking a little bit farther is because, you know, our mindset and clients who come to us want to hold on to these properties long-term. It's a 10-year hold, a 20-year hold. And that's when you can count on home price appreciation because you're going to be through a market cycle. Well, when you look back after holding this asset for 10 years or 20 years, the cash on cash return, the positive cash flow is actually going to be one of the lowest contributors to your overall rate of return. Home price appreciation, if you're investing in a growth market, is going most likely to be your biggest contributor to your overall returns. Positive cash flow is going to be one of the smallest ones. So it frustrates me when investors only look at the cash on cash return because they're missing the bigger picture. They're going to wind up 10 years down the road looking back and thinking, wow, well, maybe I got a few more bucks of positive cash flow because I went with the really high cash on cash return, but I could have gone with a cash on cash return was maybe just a little bit lower, still positive, but maybe had a whole lot more growth to it. And 10 years down the road, they might wind up with a whole lot more return on their investment. So cash on cash return is good. Another metric to look at is internal rate of return, and internal rate of return takes into account the other profit centers. It's a little more complicated. There's Excel formulas that are easy to follow to do it. It's not that hard, but you want to look at all the profit centers when you're analyzing where you should go for a real estate investment.
Makes sense to me the way that you explain it. And I was sharing with you earlier that it's obviously not to be diminished, right? Cash on cash return needs to be positive. That is, if it's not, then you're not even in the ball game, right? Mm-hmm. Kind of like a quarterback that doesn't have the arm strength to make the throws that they need to make in the NFL, but they had it to make in college, right? And exactly. Then I wanted to make the analogy of scouts and fans. Even you told me this, right? Fall in love with these guys with like rocket arms, right? And to me, that's a fallacy, right? Like I think that you need to be able to make every single throw in the NFL, but what's going to end up winning you games is that accuracy and the decision-making, as long as you have a certain amount of arm strength. Mm-hmm. While the arm strength is the most obvious thing, if you are throwing it to the wrong place and you're making terrible decisions, it's not going to win games. What do you think of that, Greg?
I think of Jamarcus Russell when you're talking about huge arm strength, did not have the ability to be a winning quarterback in the league because he suffered from some of these other things. And then relating it to real estate, right? His cash on cash return might have been really high, but his other profit centers were not that strong. And that's why he was in the league for he's known as a bust in the league, right? It's the same thing with real estate. You want to pay attention to the big picture, but not to diminish cash on cash return. Like you said, I think that's a great thing. It is your entrance into the arena. Do not get into a rental property unless you've checked that box that you're getting into positive cash flow. But once you're there, keep your eyes open. Don't have cash flow blinders on. That's what I tell folks.
Makes a lot of sense. Just to finish my analogy, Brady's not the guy with the strongest arm in the league, but he's the best quarterback out there because he has all the principal pay downs and that the Patriots put into him.
Can't we choose somebody else? I'm a Steelers fan. It still hurts talking about Brady. He is the GOAT. I give it to him, but let's talk about somebody else.
All right, let's talk about somebody else. Let's talk about Roldan Crepo and the question that he put in here that is a little bit above my skis, but I know how to read, so I'm going to put it for you. Roldan asks, what can Greg say on what is obviously an increase on listings going from pending or contingency status to back into the market status? Does this mean conventional lending has become much more difficult to access? And if so, how do you think this could affect sale prices and rental rates in like 1 or 2 quarters from now?
All right. So we're talking about pending listings going more back into active listings first? Is that the first thing? Well, I'll start with just kind of a general viewpoint. When we're talking about where pricing is, I think that was the end question, right? Where is pricing going, or is this going to affect pricing in 1 to 2 quarters?
Prices and rental rates, yeah.
Prices and rental rates. The most impactful thing to watch there is your supply and demand, your months of inventory, right? The effects on the mortgage market, depending on how big the effects are, will have an impact. But overall, what we need to focus on, number one, is months of inventory. And so specifically in Jacksonville, your months of inventory is extremely low. It is 3.5 months of inventory last time we checked in May, and 6 to 7 months of inventory is known as an equilibrium market. And we've been below 6 months of inventory since 2014. So historically low. What that means is that even if you have some negative factors as far as decreasing home sales or increasing inventory, we have a long runway before we would expect to see a decline in prices. Because 6 to 7 months of inventory just simply means you would expect to see normal average home price appreciation. Pablo, what's normal average home price appreciation in Jacksonville?
4.3%.
Nailed it.
Yeah.
Nailed it. There you go. 4.3%. So if you're at 6.5 months of inventory, that would lead short-term pricing to indicate that you would see normal home price appreciation, 4.3%, if you wanted to get technical, right? You would need to see months of inventory over 7, well over 7, to get to a decline in pricing, right? So if you're at 3.5 and you've been there for a long time, it would take a whole long time or a whole lot of decreasing sales or additional inventory to get you to 7, 8, 9, 10 months of inventory. I actually did the numbers, and if home sales declined by 50%, dropped in half from last month to this month, that would put us at 7 months of inventory, which would still be equilibrium, right? So, and that's a half of sales dropping in half. So the point here is that there's a whole lot of negative stuff that could happen before we would expect to see pricing decline. You know, I actually haven't been paying attention to pending listings going back onto the market. You know, I'm sure you have some data to see that. I haven't been paying attention to that, so I can't really speak to that. And mortgages, you know, there was a huge shakeup in the mortgage market when coronavirus hit. Things are actually getting back more and more to normal. Prior to coronavirus, it was really hard to get a mortgage. It's still hard to get a mortgage today, but it's not impossible, and it's harder, but it's not noticeably different to get a mortgage. Where a lot of the mortgage kind of fluctuation happened were providing loans to investors like like JWB, right? JWB many times will take a big package of our rental homes that we have in our portfolio, and we will go and we will finance those, or we will refinance those. And there's a specific type of lender. It's more of a private equity firm type based lender who we would go to. The money there stopped for a couple of months, but actually it's just opening up again there. So on the front end, you know, a big part of the recovery for the country is making sure interest rates are low so that people can continue to borrow, continue to buy houses and things of that nature. So short answer is I don't see a noticeable impact coming from either the pending listings or the process of getting mortgages for homeowners and individuals investors being somewhat more difficult. I don't see that having an effect and causing a decline in prices in the next 1 to 2 quarters.
Makes sense to me. Can you tell me a little bit? You said prices would have to drop 50% to get to 7 months of inventory. Can you explain that a little bit?
That doesn't make a whole lot of sense. If I said that, that was wrong. Home sales would have to drop 50%.
Okay.
Right? So we had like 2,400 home sales last month, right? Running based on the current inventory we have, you'd have to have like 1,200 home sales in order for you to get 7 months of inventory based on the numbers there. Dropping by, from 2,400 to 1,200 is huge. I mean, that doesn't just happen overnight. So just further credence that it would take a long time and a whole lot of negative events to lead to a point where we would expect to see prices decline in Jacksonville.
Okay, that makes sense. Yeah, I just probably heard that wrong. So Abraham Guerrero here has a interesting question. It's speculation, right? I'm gonna let you speculate. But Abraham Guerrero asks, some are talking about another worse wave of coronavirus and lockdowns, including job losses again, and rent payments may be in danger. What do you think about that?
Well, I think that there are positive signs, but I think we have a long way to go. I think we need to be vigilant with this. There are some positive signs though, right? The entire world was shocked when the jobs report just came out. Many of us have probably heard about it so far, but prior to the jobs report coming out from the government, they were expecting unemployment rates to rise to 15 to maybe 20%. And they were expecting to lose more jobs in the month of May than were gained. Well, what actually happened was we gained 2.5 million jobs and the unemployment rate went down. Nobody was expecting that. So there are some positives that we were not expecting. But the reality is that we got tens of millions of people out of work, right? That can't be a good thing. I mean, what we're paying attention to mostly is how does this recovery continue to happen while the benefits from the stimulus package no longer are there. So the biggest thing that can affect rental rates is the unemployment benefits that are going on through July 27th. So the federal government is adding an additional $600 per week for anybody who is unemployed and who was affected by COVID. And that's in addition to the state unemployment benefits that they would receive. And so what's happening is many times people are earning as much or more while they're unemployed. And that's going through July 27th. After that, the state unemployment benefits continue. They extended that, I think it's up to 36 weeks or 39 weeks, something along those lines. So they extended it. So that will be in place for a long time for people who are unemployed. But it'll go back to maybe them receiving maybe 40 to 60% of their earned income with them being unemployed, right? So I think the biggest thing to watch is what is the economy doing? And this jobs report, I think, is really, really important to pay attention to. Obviously, we need to pay attention to what is going on with coronavirus. Is there going to be a second wave that's going to hit? Are we reopening too soon, right? These are obviously very, very important questions for us to pay attention to. And also, pay attention to the renting side of it as well, right? Right now, you can't actually foreclose in the state of Florida. That's been extended through July 2nd. For most mortgages, you can't even foreclose until the end of August as well. So we're mainly watching that. How's the economy doing? When are the stimulus benefits going to run out? And when can you get back to normal property management? And a lot of that's going to be known as we get closer to July and August. So early indications, some are better than expected, but we're not out of the woods yet. We need to make sure we're vigilant with this for a long time.
Yeah, and that's early indications on the overall market, right? But on the micro level, for JWB clients, we've had 2 months of coronavirus effect. Many of those benefits have not hit yet, right? So people have not received that cash flow. And yet, how is rent performing?
It's performing incredibly well. So in a normal month for JWB, sees us collect about 98.5% of rent. In March, while we only had maybe a couple of weeks of the coronavirus impact, as far as rent collection, we collected 98.75%. So better than normal in March, which was awesome. And that shed the spotlight right on April. How's April going to do? And I was a little concerned too, right? I shared with everybody on our group. They asked me, what should I expect? I said, for my own 300 plus rental properties, I'm expecting a short-term temporary loss of rental income. Well, I guess I was wrong because we collected 97.5% of rent in April, which was incredible. Great testament to our team and the relationship that we have. May, we are tracking even better than that. I didn't check it right ahead of time. I checked it a few days ago and we were over 96% collected. And the way to track it is you actually give yourself through the next 30 days once the month ends. So we still have, 3 weeks to get closer to 98.5% in May. So yes, on a very micro level, I don't have concerns about rent collection because we've been through what should be the worst of it, right? Where people have not received benefits, the unemployment level was higher than it is today. And we continue to be able to serve those residents. Those residents continue to be able to pay rent. An incredible testament to our team and the wonderful working relationship that we have.
And I also just want to clarify, also during a time when you can't evict people.
Yeah.
So it's all of those, all the worst, the worst case scenarios, yet it's performed, which when I hear this stuff happening, number one, I think of how good JWB is at treating their, growing a relationship with their tenants and how you think long-term and how that pays off. But I also think that there is something to the idea that housing is, after food, housing is the number one thing that you're going to spend your money on, right? So you're going to cut everywhere else. And two, the sectors that y'all have houses in are these sectors where people live because they can afford it there, right? Can you kind of explain where I'm going with that? I think you know where I'm saying.
Yeah, I think this is an asset class that is a critical need. That's kind of the first thing you're talking about, right? Yeah. In times of great stress, it is so nice to be investing in something that's a critical need, because if it's not a critical need, people don't spend money on it, right? And it's a critical need for the individual, and it's also a critical need for the government. Housing is a critical need for the government to be going well, or at least to not be collapsing, right? So many other effects if housing suffers. So that's why you're seeing the stimulus package, the CARES Act came through, and it specifically was putting that extra $600 a month, $600 a week into the pockets of unemployed people so they could pay rent and they could buy food, right? So there's that. And then as far as the neighborhoods that we're in, we're in middle class to below middle income neighborhoods, right? Where there are jobs and there are affordable rents. I mean, Jacksonville overall is known as an affordable city because of the low cost of living. So that helps us. And then these neighborhoods are lower on the pricing scale for rents and for prices than even Jacksonville overall. So, this is not a good time for anybody, right? But if you could be in somewhat of an insulated asset class, somewhat of an insulated city, and then somewhat of an insulated neighborhood, that's where we have chosen to invest for 15 years because it's protected, right? It is insulated. It is the numbers, the financials make sense. And that's why we do it. And that's what we're seeing playing out.
There you go. I agree. Great. I'm going to ask you something I think is going to be easier for you to answer. Mediatrix Garcia asks, is there an ideal amount of cash flow that we should base our criteria to purchase a rental property?
Yeah, I'll go off of our properties. You're going to find around $200 a month, maybe $225 a month of positive cash flow in a JWB rental property. Anything slightly above break even for me, including all of the potential costs that come your way, is a good deal, right? It's the entrance into the game is positive cash flow. And so, you know what? If you can be in a growth city and have great property management, and you can get a couple $100 a month in positive cash flow, that's fantastic for you. The big point though is it worth it for you to go and get $300 a month in cash flow and go to a city that's not growing and go to a management company that you really don't enjoy doing business with? And I would tell you emphatically, no, it's not worth it to do that. And unfortunately, that's where a lot of investors fall into that trap. And part of that is because the easiest way to quantify a rental property investment is cash on cash return, right? That's why people do it. That's what they put on their fancy spreadsheets. It's cash on cash return. And, 12% in some other market that doesn't grow sounds a lot better on paper than, 8 or 9% in Jacksonville. But they're not counting the growth component. They're certainly not counting the management component. And sometimes those other property evaluations aren't even counting all of the costs that come along too. So do your due diligence, go through with a fine tooth comb. But yeah, somewhere around $200 a month is a great cash flow number for you.
Great. Nailed it. And listen, time flies when you're having fun. We've come up on a half an hour. I still got a couple of crowd generated questions and a couple things I wanted to pick your brain on. Greg, you get to go a little bit longer?
Let's do it.
Super. So for those of you that only had a half an hour set out for your calendar, I just want to reiterate the fact that if you want to get a beginner's intro into rental property investing, that's going to be a real good use of your time. Get your IQ up on what this asset class is and how to do it properly. Go to jwbwebclass.com. And if you're already there and now you want to talk about how it can affect you and how you can get into the game, go to chatwithjwb.com, pick out a time, date, hop on the call with our guys, and they're going to help you out. You're going to have a blast. So we can move on now. And I lost a little bit about my train of thought. No big deal.
But you were talking about user-generated questions.
Yeah, user-generated questions, correct. Oh, no, you know what I wanted to ask you about, Greg? Because, all right, so we're talking about cash flow and we're talking about the market and whatnot. You highlighted a property on Friday.
Yeah.
And I wanted to touch base on that. I noticed that in your property, it is a 9.3% ROI.
Mm-hmm.
And I'm very used to you telling me that on average, you tell your investors 7 to 9%.
Mm-hmm.
Yet here we are, 2 months into coronavirus, blah, 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 like world's melting. And you still are offering a property on the market that is slightly above what you normally tell people. Can you just kind of reflect on that?
Yeah, absolutely. And I thought it was one that I should share with the group. That's what we did. And every Friday now, I'm going to be highlighting a property that I want you all to take a look at, whether that's a learning opportunity for you or it's an investment opportunity for you. There's something about the ones that I'm going to share with you on Fridays that are going to pique your interest. So 9.3% estimated rate of return is a really strong return, even for JWB. Specifically this one, the reason why I chose this one is because I've been getting a lot of questions about how do I make a decision based on buying a new construction property versus a renovated property? And here, what we're talking about, this one on Blazing Star, and maybe, after this, maybe what I'll do is I'll post the financials of it in the comments section again. But this one is a renovated home. And so when folks ask, what should I do? Should I go with a new construction home or should I go with a renovated home? Which one is better? My answer is yes. My answer is yes, right? They're both great. Out of the hundreds of properties that I have in my own personal portfolio, the vast majority of them are renovated properties, right? I've been buying them since 2006, right? We didn't start building new construction until 2011, continued to add both renovated and new construction in my portfolio. And how do I make the decision? I go with the one that has the highest rate of return first. That's my first decision, right? Renovated homes are just as good as new construction homes. And here's how the differences work. So for a new construction home, you're going to see slightly lower maintenance and vacancy cost, slightly lower. What you're also going to see is lower insurance cost, homeowners insurance cost, because it's new construction. What you'll also see is a higher purchase price. So you'll generally see a purchase price is getting closer to $200,000 for new construction. Now, for a renovated home, you're going to see slightly higher maintenance and vacancy cost, which is reflected there. You're going to see slightly higher homeowners insurance cost, and you're going to see a lower purchase price. So all of that shakes out to getting to that 7 to 9% estimated cash on cash return, which gets you roughly around $200 a month in cash flow. And so you can get there either way. And people will say, well, yeah, but is a new construction property going to appreciate more than a renovated home? I say, I don't have any data to support that. And the other thing I bring up to them is that for most of the investors, right, we only bring investors on who want to hold long-term. When you're holding long-term, when you're holding for 10 or 20 years, I always tell them that new construction is new for exactly 1 year, and when you're holding on to these assets for 10 years or 20 years, if you look back right now, homes that were built in, 1970 do not appreciate more than homes that were built in 1990. Right? It's just not going to work that way for the long haul. And you're not in this to fix and flip and all of that. So, really both of them are incredible assets. We start with what's got the highest estimated rate of return. And we also look at the budget. And that might be why we might go more towards a renovated home, or that might be why we go more towards new construction homes. But both of them are great assets to include in your portfolio.
Great. Nailed it. John Evans has a question here that I'm generally going to answer. You can add, but he's asking, are these chats only Tuesday and Thursday? And what is this Friday chat time? John, that is, so what we're talking about right now, we have our calls on Tuesdays that are interviews with Q&A. And then we have our Thursday calls that are what you're doing right now. Me and Greg doing Q&A from the crowd mostly, or, talking about quarterbacks. But we also have a Facebook group that is over 1,300 people. It's our clients, our friends. It's at jwbfacebookgroup.com. I highly suggest you join it. Many of the people that you're seeing here commenting are there and interact with us throughout the week. And Greg goes live into that Facebook group every weekday with a real estate walk and talk. And on Fridays, he does a live that he highlights a property, right? So I would just recommend that you join our Facebook group. It's jwbfacebookgroup.com. I'm going to send it here and put it in the chat. But that's what that is.
I'm going live on location tomorrow. I've already planned how we're going to go and do one at the actual property, so you guys can actually see me walk through it. Not just me sitting behind the mic here. We're going to be live on scene.
Very cool. And Greg, do you normally do it at around the same time, or does it kind of vary?
I don't know. I would like to say yes, but no, sometimes the world gets in the way, but I always do it. I haven't missed one yet. But normally I would say it's normally in the mornings. I'm trying to either do our walk and talk somewhere around, maybe 10:30 to noon or so every day. And I've started to put out some notifications in the group. I'll be going live. We'll be doing this walk and talk or whatnot. So somewhere kind of mid-mornings usually when we're doing it.
Cool. And he had a follow-up question to what you just said, which, maybe you can just touch on it again, right? But John Evans asks, don't new constructions tend to appreciate faster than renovated, especially since newer neighborhoods, i.e. renovated, tend to be 90s properties?
Yeah. I mean, I think if you're trying to fix and flip and sell a house tomorrow, buy a house today and sell a house tomorrow or in the same year, that new construction does sell at a premium. But the perspective for most of the investors on our call here and our clients are the buy and hold for a whole long time. And so there's really not, as I mentioned, new construction is new construction for 1 year, right? There's not a whole lot of data to say that specifically 1970 homes appreciate less or more than homes built in 1980 or 1990 or 1950 or whatnot, right? Just not a whole lot of data to support that. And that's what you're going to find yourself in if you hold on to this for 10 or 20 years down the road. So there's a whole lot of important criteria, I think, to be able to make the right rental property decision. But specifically based on age of the home, is that going to appreciate more? If you have the long-term mindset, I don't think that really matters.
Okay. Media, I think I'm going to pronounce this right. Is it Mediatrice, like Beatrix, Mediatrix Garcia is asking, is it better to pay a property in cash or leverage by securing conventional loans?
Wow, I love that question. And that is a really important topic. It's highly personal to your goals. And so I can't give a one size fits all. I've sat down with clients, my team has sat down with clients, and after understanding what their goals are, and we've recommended you should be buying these in cash. And then another client comes and sits down, we understand what their goals are, and we say, listen, let's go financed for these. So what I would recommend is to go to chatwithjwb.com and have a personalized conversation with my team about it. But I'll give you just a few pointers here. So especially for younger investors, the ability to leverage and to use debt smartly is so incredible. And it's specific to this asset class, right? You can't go to the stock market and get inexpensive, smart leverage, right? You can't go to oil and get that, right? So, but you can get that in rental property investing, right? I can go out, you can go out and buy a rental property right now, go to Bank of America or any of these big banks down the road, and they might be able to give you a loan in the 3% and 4% interest rate, right? They only do that if it is a low risk to them and it's something they feel really confident in, which is what what lending on rental properties has been for banks for decades now. And you are the benefit. You can benefit from that as an investor, right? And the most amazing thing is that by buying smart in the right market, in the right neighborhood, with the right team, you can buy an asset that takes that smart debt into account, the cost of that every single month, and pays you more than that every single month, which you can't do in other asset classes. So I love using smart debt, especially if you're a younger investor, and buying assets that pay for themselves over time, right? Because what you're doing is you're creating an income producing army. Every property you buy is an income producing army. And you're going to wind up in 10 or in 20 years having a whole army of assets producing income. And oh, by the way, they will have appreciated nicely if you invest in a growth market like Jacksonville. So kind of generally speaking, for younger investors, we usually explore financing. Now, for those who might be closer to retirement, financing might not be the right play for them, right? I'll give an example of my father-in-law. He is close to retirement, right? And he owns 4 properties with us. In the beginning, he was buying them with financing. On the last one, he purchased, we bought it with cash. And it's because he's nearing retirement and didn't want the debt. And we openly talked about the fact that your return on your investment is higher using other people's money, using leverage, buying with financing, your return on investment is higher. But that's not the end all be all best decision for him, right? Higher cash flow was more important to him, and not having debt was important to him at his life. So generally speaking, as folks near retirement, they're more open to buying properties not using financing. So not a one size fits all answer, but hopefully that kind of gives you a few guidelines there.
I thought it was a much better answer than the way that I pronounce her name. She said, just call her Medj Garcia. Thank you, Medj,
all right.
for contributing. Mike Foster has an interesting question that I think you're going to like answering. Since turnkey rentals are long-term investments, do JWB principals, Greg, Adam, and Alex, intend to remain in this business in the Jacksonville area for the next several decades?
Yes.
Done. Next.
Yeah, absolutely. We love what we do, right? We get this question, are we going to go to other markets? Or, would we try to sell this business? And my first thought is to the other markets question is like, why would I do that? Right? I don't know why people feel like they need to build a big, like a business, something they really, really love. And then for some reason it's not good enough and they need to go and do something else elsewhere or whatever. Like, I love my family time. I love everything about Jacksonville. I love our team, right? Like, I think it's a risk to our clients if we were to go and spread ourselves to other markets. Like, why? I can never answer the why question. The answer of money is not a good enough answer for me or my business partners. So that's an easy one there. And then, do we intend to stay in the business long-term? Absolutely. Right. Like, what would I do if like, it would be, I don't know what would I do? Right. We've been able to build this business to something that, we are so passionate about. It's something we love. We love building and growing our team. We love working with our clients. Mike's been a client for, I don't know how long. And he and I have had great conversations. Like, why would I give that up just to make a buck, to go and have to restart it somewhere else, or to be bored and not do anything? I don't know. I can't answer that why either. So yes, go back to your question. We will be here for the long haul. That's our intention.
That's a good answer. And I want to shed some light on that, right? Like, we've had the conversation of, Greg, would you ever possibly, right? Like, we're doing it in comparing you to Tom Brady again, which, by the way, Mike comes in with a nice little low blow where he puts, you do look slightly like Tom Brady. So if you have a strong arm, another career. I guess that's not a low blow. I mean, being compared physically to Tom Brady is not bad. But what I wanted to say is, number one, you are 36, right?
37.
I mean, 37, right? Like that, like the idea that you have a long career in front of you, I can't, and you love what you do. It's very obvious. Why would you go anywhere? We talk endlessly about how much of a paradise and how much of a secret the quality of life of Jacksonville is, right? Like, I can't imagine, after being here just 2 years, I can't imagine going somewhere else. And 3, you guys own like 300 or so properties. Like, you own like 300 properties here locally. Like, what are you going to do with all that stuff if you were to go anywhere? Right. Like,
yeah.
Anyways.
Yeah. I don't know. The reason we started the property management company is because we believed that was the best thing to do for our clients and for ourselves, and believe that nobody else was going to care as much. And so then, I don't know, not even worth exploring.
Yeah. Plus also put it on the scoreboard. You all are making investments in downtown that are a 20-year, 30-year kind of window, right? So, like, if you want to not just listen to what you're doing, but see what you're doing, you guys are betting long-term in downtown right now in a very futuristic way. Do you want to kind of talk about a little bit about those?
Yeah, I can talk about some of the things we're doing downtown, and then some of them I'm not at liberty to speak of as well. We look at downtown Jacksonville as having all of the recipe for an incredible revitalization. We feel like it's untapped potential, and if you've talked to a lot of Jacksonvillians here for many years, that's how we've described downtown for a long time. But we feel like things are in process now that Jacksonville's revitalization is going to take major steps forward, and we want to be a big part of that. And the reason that we do this in relation to our turnkey investors is because when you invest and you see downtowns grow, it has extremely positive effects for the local economy, and it has very positive effects for the neighborhoods that surround downtown, which is exactly where we put our investors, which is where I own my own rental properties. And then another part of this is we see this as an opportunity. You know, there's only so many moments in time to have a noticeable impact in a downtown center, in what will be a thriving downtown, and we want to kind of make our mark on it. And we think of this as kind of like a once in a lifetime opportunity. So we're being very specific and calculated, but we're investing in some buildings downtown, and we're doing this. This is something that we started to explore a year ago, and we've taken some calculated steps. We purchased the Sweet Pete's building on Hogan Street in downtown Jacksonville. You guys might remember that one. It was actually a building that was owned by Marcus Lemonis from The Prophet on the CNBC show. And that business, Sweet Pete's, was featured on his show, The Prophet. And so we actually bought that building, and Sweet Pete's is there. We love them as a tenant, and there's more good news coming. So we believe in downtown. To get back to Mike's question, and I'm glad you pointed it out, it's just further actions that solidify what my simple answer was, which was yes. We're going to be here for a long time.
Yeah. Like I'm just super jacked up about how awesome Jacksonville is, man. So I wanted to drive that point home. So Mike coming in with more. By the way, Mike, are these your questions, or are these your guests' questions that you have here? Because you got great questions today. What were they? Jack and Nan, I think, are watching with you. We want to welcome our youngest viewers so far, Bubby and Nan.
All right, welcome.
Yeah. So Mike has another question. How does your relatively small property management team handle the management of hundreds of properties each month? Rent collection, yard work, repairs, all that.
Yeah. It's funny that you say relatively small. The team's grown over the years. But in comparison to managing 3,500 rental homes, it's pretty crazy. I mean, one property manager can manage somewhere around maybe 400 properties, and we're getting closer to 500 properties. So the way that we've been able to do this is to invest in our leadership and invest in our systems and invest in our training. So about 2 years ago, we made a major investment in Salesforce, which has been a long journey and incredibly, there's so much potential with it. We're excited about it, but it's been a long journey, and it's hard to move all of your systems in like 17 different systems that we have over to one behemoth of Salesforce. And we're already seeing huge gains. So not too many years ago, one property manager could manage 250 properties. Now they're up to about 400, and we're getting closer to 500 properties. So we understand that's a really important opportunity for us as a business to continue to serve better and better, but also become more efficient and really be a leader in the technology space, which has been a long opportunity that we saw coming in, and we jumped in a couple of years ago. So we're going to continue to do that. But, we're just committed to systems. We're committed to training. We're committed to building up our leadership from within. And, we have multiple layers of leadership now. We have an incredibly strong supervisor team. We have a management team, and, we also have our leadership team, which would be the four owners as well. And all of us together meet quarterly, go over the business. And, those are things that we've implemented. Parts of us, we have been doing this since the beginning, but we rolled that out to our management team. And now we include our supervisors, and that we've taken some really big strides over the last couple of years that have helped us support an organization of over 80 people now. So, we're going to keep doing that, and we're going to keep growing our property management business and keep getting better. And and then we'll continue to get more and more efficient.
Yeah, Mike, I make no bones about my absolute admiration for JWB's operational kind of, man, I don't even know what to call it. Their efficiency, their talent at operations, which are so obvious the moment that you walk into that Tuesday morning meeting and you see everybody on the same page and you see the culture and in and out, and just the idea that that you're able to do it, that you're able to, that you and your partners, the four leaders of the industry, are offsite and unreachable every single Wednesday. And then once a quarter, the leaders are off and all the managers are offsite and unreachable for a whole day, and stuff goes out without a glitch. To me, is just really a testament of how much systemization has gone into what you are done and how successful it has become of your investment in systemization.
Systems have always been something that has just been inherent to us, but I think that's even more of a statement to the level of talent and the level of care that we have and the level of just professional folks that are on our team. It starts with the hiring process. I mean, our hiring process is really difficult. We've been featured as best places to work now for 7 or 8 years now. And because of that, people seek us out to apply, which is incredible. I remember when we were first starting and how hard it was to convince some of my friends to be able to, jump on board with us. But if you go to the website and you want to apply for JWB for a job, you first have to fill out a paragraph about why you want to be an A player. We don't even want to see your resume. You actually have to think and write, just to be even considered. And then there's multiple interviews and steps. And then we bring you in for a shadow, where you get to work at JWB. You're not paid yet, right? You get to sit down with people that you're going to be working with, actually get on the phone, see how this thing works, do whatever the job requires, get out in the field and see if you like this and see if we like working with you. And this process takes a long time. So I think, the ability for us to remove ourselves to build the business, every Wednesday, as Pablo mentioned, my business partners and I are off site. We are not in the office. Our team does not, reach out to us because we're focused on building the business. You only do that when you have great talent and the systems to support it. But I'd say the talent is the big thing.
Yeah, and if anybody wants to get a real in-depth look at that hiring process and the way that they systemize and communicate as a company, there's a past Not Your Average Investor show that we did dedicated to that you can see on our YouTube channel. It'll be coming up on the podcast soon. Again, you can join our Facebook group. They're all in the units in there as well. And John Evans was asking, is the Facebook group JWB Rental Property Investing? You nailed it, buddy. That's where it is. We just made that jwbfacebookgroup.com link to make it really easy, because in past episodes, I kept bumbling JWB Rental Property Investing like I just did. So Marilyn Cotterman has another follow-up question. Do you know what percentage of JWB investors are local in Jacksonville and surrounding areas? Just curious.
I haven't looked at it. We put it together a long time ago. I mean, I would say maybe less than 10% are here in Jacksonville. Vast majority are across the country. They're in 43 states, 13 different countries, and the majority are in the high priced states, right? Your Californias, New York's, Virginia, right? Those are areas where they love the idea of rental property investing, but they can't go to their local market and can't get rule number one, which is positive cash flow. So then they'll come to a market like Jacksonville.
Yeah, makes sense. I mean, when I was in Miami, I heard of JWB because it's not a high price state, but it's a high price city, right? Mm-hmm. So I couldn't do it. And that's what we got for you so far, Greg. I think it's been a really, really good show, man. You really knocked it out. Oh, okay. Well, John's got one more question. John Evans asks, Greg, how long has Gregg Cohen been active in real estate investing?
I started in 2006. I read the book Rich Dad, Poor Dad. It happened. I read that book at a time in my life where I was really depressed because I was working in corporate America. I read that book. I literally picked it up the same night. I read it through the entire night, put the book down. I remember looking at myself in the mirror. It was like 2:00 in the morning. And I said, I'm going to quit my job and I'm going to start my own real estate investment company. I'm going to build up a rental property portfolio. And that's when it started. That book is powerful. So read Rich Dad, Poor Dad if you have not yet. and just be prepared. You may make some different life decisions afterwards.
And John, if you sound like a great candidate to go to that jwbwebclass.com, because that story is there, right? And you'll and you'll hear a little bit more about that. So I do encourage anybody that, again, like John, who seems to be new to meeting JWB maybe the first time. Welcome, my friend. We hope to have you every Wednesday, every Tuesday and Thursday, and in that Facebook group, and everybody else that's joined us this week. I see, a bunch of people that show up to everything. Everett Shapiro, good to see you. Pop. Lee Bishop, as always. Marilyn Cotterman, great to see you. Medj Garcia, hope to get you back. Mike Foster, Rich Glover, Roland Crepo, everybody that's here. Victor Scarpula, Thomas Price, Scott Bellotti, Rick Williams, everybody that's here. I hope to that you stay engaged with us. Keep coming back to the shows. And if you have a question that needs to get answered, go to chatwithjwb.com, fill out a time and date for an appointment with the guys, and we'll help you out right there. If you want to get started, jwbwebclass.com. And as always, this is so much fun. I really enjoyed doing this. I love the participation today. Today's really one of my favorite Q&A calls. So Gregg, it's a tribute to you that you're able to knock this stuff out and provide all that value, man. And I'll let you get last word.
Oh man, you're too kind, man. I want to hear one of these times when we're sending off the show, and I want you to be like, Gregg, listen, you really sucked today, man. Like,
I'll let you know.
The pooch, man. We have a blast. I mean, it's amazing. Pablo and I were talking in our meeting earlier this week how cool it is that we have 30, 35 folks that spend an hour with us on Tuesday, on Thursday. I think the Thursday crew, you can even feel it's really different. It's even a little bit less formal and just more of all of us kind of interacting. And I just appreciate all of you. This journey of going on social a little bit more and doing this show really started about 2 years ago. And I had trepidation in the beginning because I didn't really feel like I was that guy who was going on social and all of that. And, I just leaned in and I didn't really know what to expect. And to see 30 folks, 35 folks, and all the positive comments that you're all making, seeing that this is a value to you and that you're enjoying yourself and having fun like we are, means a lot to me. It means a lot to Pablo. It's seeing our little dream here realized. So I appreciate all of you spending your time with us. I hope to see you on Tuesday at 12:30 and then on Thursday at 12:30 and sort of making this a part of your normal week. So with that, on to the next one, my friend. Thanks again.
On to the next one. I'm just going to read one last comment here because I love it. Abraham Guerrero says, "Hey, Gregg, I really appreciate the values JWB stands for. It's been a great experience so far to own the first 5 properties with you guys. Let's get to 20.
Oh, congratulations, Abraham. We appreciate you, my friend, and looking forward to helping you do that for sure.
All right. See you all on Tuesday. And in between then, we'll see you in the Facebook group.
See you, everybody. Bye.
Bye-bye.